Hi all, and welcome back to Money Managers, a User's Guide. My name is Nathan Peters. Thanks to all the viewers who have put up with a lack of production from me this summer. I'd prefer to have posted consistently, but in my defense, after 15 years in London, my family and I are in the process of moving to Sydney, Australia. Yes, all 10,553 miles in the middle of a pandemic. Why not? Hopefully you'll see a new background on the channel, and if we're lucky, it'll include an actual ocean view. In a professional update, I have resigned from my full-time position on the buy side in order to make this big move, but I'll be working on a freelance basis as an advisor going forward. It's an exciting time for me and my family, and as you can see already, I'll be taking the opportunity to branch out and try some new things with this channel, including more chats with promising money managers, as I did a few weeks ago with Matthew Bedall at Havelock London, link in the description below. But enough about me, let's get to the topic du jour, which is China, China, China. What is going on over there anyway? Well, old-timers like me have been waiting for years for a real estate-led decline to occur. In fact, you can find YouTube videos from over a decade ago ringing the alarm bells. A little too early to be crying about it now with the Evergrande fiasco, I might add. I mean, what are Western free market people doing buying Chinese securities anyway? Really? I mean, even just on ESG grounds, you'd have a hard time justifying buying these things, let alone from a financial perspective. The Communist Party is interested in the trappings of capitalism as long as they're useful. When it ceases being useful to its own goals and power structure, we can pretty much forget about niceties like seniority in the capital structure. And all this is well documented. What perhaps is not is why the BlackRocks of the world, the largest players, seem to be so keen to enter anyway. I think part of the answer lies in the ever-elusive alpha that we focus on so intently here on this channel. It's not that BlackRock thinks China should be part of everybody's portfolio. It's that if they convince enough Westerners to take the plunge, they are betting they will be allowed to operate more freely in China's domestic market. Why would they want to do that? Well, the A-share market is notoriously large, diverse, retail-driven, unsophisticated, and volatile. Shades of crypto, really, if you think about it. The perfect playground for savvy traders to earn excess returns. The problem was always the lack of borrowable securities in the market with which to go short. The solution is more securities held long in index products and available to lend out, thereby creating the supply of securities the short sellers need to sell. Over my career, I've been astounded by the consistently high positive alpha that the best players in the market can generate within the A-share market. And the more market neutral they are, the more consistent the returns are. Case in point, the Marshall Wace Tops China A-share UCITS fund. This is a public fund priced daily on Morningstar, so it gives us a good test case on what a hedge fund can do, even if this particular fund is only a 130% long, 30% short fund, which exhibits a 1 beta to the index. It was launched in 2016, but since it focused on the A-share market exclusively in 2018, it has minted excess returns at a rate of 14.5% per year, better than you'll find pretty much anywhere else. China has been underwater since last February here, and it's currently in a minus 12% drawdown. But this fund is holding up well, only down 3% from its peak, despite its mirrored correlation in beta to the market. If anything, it seems to do better when the market is volatile, judging by this cumulative excess residual return chart. Just imagine what you would get if you could effectively manage a large gross short book against your longs, 1-to-1, or, depending on your risk tolerance, 3-to-3. The holy grail, pure double-digit uncorrelated alpha. Guess who offers a market-neutral, Asia-focused fund in UCITS? That's right, BlackRock does. Link in the description below. As we can see here, this is just post-COVID shock. If the market is up, the blue line, or down, the BlackRock fund here on the bottom, brown line, just keeps making money. Sneaky smart there, BlackRock. Let's hope the PRC lets us play in their sandbox a while longer, and not just for alpha's sake. Maybe we can improve their ESG scores as well, if they'll let us. Well, that's it for me today. Thanks for tuning in to Money Managers, a User's Guide. If you appreciate this content, remember, like, comment, subscribe, hit the bell for notifications for future episodes. And remember, use your money managers. Don't let them use you. Thanks.